Hello and welcome to Chapter 17 on the stock market. So first of all, we look at what stocks are. Stocks are essentially pieces of paper that represent, or these days digital records that represent part ownership of a corporation. It's mostly medium and larger firms that issue stocks, but some small firms can also issue stocks. And they are a hallmark of the capitalist system. Sometimes stocks are called equity. So you hear market commentators talk about the equity markets. What they mean is basically the market that trades in stocks and shares. And that's why they're called stocks and shares, because they are also a share in the ownership of the corporation, of the company. So in the stock market, we have people who are buying and selling stocks, and this is completely down to the model that you've seen in microeconomics, so demand and supply. And the market reacts very, very quickly to those two features. So for example, if a company decides to suddenly issue a bunch more stock, so more shares for the general public to buy, then because the company has a certain value at a specific point in time, it means that the existing shares are diluted in terms of what they're worth. So you automatically see a drop in the price of the existing shares. In other words, each share is just basically each share is basically given the value of however many shares are issued, in terms of the division of the value of the company between all those shares. So for instance, if 10,000 shares were issued, then each share would be worth 1/10,000th of the value of the company. Obviously, if you issue another 10,000 shares, then there's a total of 20,000 shares issued, and each share is now worth 1/20,000th of the value of the company. So that's why when you get what's called a secondary issue, the value of each individual stock falls. So corporations really have a choice of how they can raise money, what's known as capital in finance. Notice that this is different from the definition of capital in economics. In economics, capital is plant, machinery, and equipment. In finance, capital is basically money. So corporations can raise money by either borrowing those funds, in which case they would go to the bond market if they're a large company, or go to banks, or go to other investors to borrow those funds. By the way, you see that happening on Shark Tank every week on CNBC. They have this program called Shark Tank, which hopefully most of you have seen, whereby companies pitch their ideas and their products, and a bunch of entrepreneurs or investors, I would say, they're mostly entrepreneurs who are investors as well, essentially do deals for lending money to the individual companies. The alternative, of course, for the medium to larger size companies tends to be to do what we call an IPO, or an initial public offering. That is to sell shares to the general public. Now, some companies as well, by the way, decide to raise capital by not selling those shares to the public, but remaining private by placing the shares with people that they want they want to have associated with the company. So for example, you cannot invest in HEB. HEB, however, is a private company, and the Butts family still own shares, and other individuals who they've decided to bring in to the ownership of the corporation, ownership of HEB, also own shares as well. So there are shares out there, but they are privately held. And with privately held shares, what happens is you basically, if you want to sell your shares, sell your ownership, you inform the secretary of the company, and then they contact the other shareholders and ask if anyone would like to buy the allotment of shares that that particular individual or entity has. So that's how that works. No one from the general public is permitted to buy those. They have to be approved as shareholders by the rest of the shareholders. There are two types of stocks. There's a common stock, that's the regular stock that's issued by corporations, and then there's what's known as a preferred stock, and there's a variant on that called the convertible preferred stock. Okay, what's the difference, you might ask? With the preferred stocks, they often pay a dividend, whereas often the common stock does not. And the preferred stock as well is paid off in the event of bankruptcy before the common stockholders are. So in other words, if a company goes bankrupt and they look at the value of the company and they decide, okay, well, we paid off the suppliers, we've paid off the bondholders come second, then who do we go to pay off? Well, we do the preferred stockholders first, and then we go to the common stockholders. Now, a convertible preferred stock is an interesting type of stocks because what it is it's a preferred stock that then converts at some point into the future into a common stock. Now, some investors like this because if the company is setting up and it's making losses initially, then the common stock may not be worth much and may not be rising at all. So with the preferred stock, at least you get a dividend. And then as the company begins to grow, the preferred stock converts into a common stock once the company is profitable and then grows quite rapidly perhaps, and then it's better to be in the common stock in that instance. So there are two types of markets. We've already mentioned the IPO. So that's a primary market. So that's the first time that the share is sold to the general public. It's called an IPO, or initial public offering. These happen on the New York Stock Exchange and on NASDAQ, which are the main trading platforms in the US. And what happens is the market makers get together and they decide on what the demand is for this particular stock and what the supply is. And they have underwriters, people who have committed to buying that stock at a certain price. So they price them in there. And then if the demand is sufficient, then the first trade is done such that demand and supply match. So that's how people who actually commit to buying the stock, underwriting the stock if you like, can make substantial amounts of money, because if they commit to buying it at $10, but the actual demand turns out to be at around $20, then they've immediately got a $10 per share gain. So for example. And secondary is just once it's been sold into the general public, it's the reselling of that several times, or however many times it gets resold. So notice there's an interesting element here as well. With an IPO, the company is actually raising money, which in turn then allows the company to invest. Invest, in other words, in an economic sense, of purchasing new plant, machinery, and equipment and expanding the business. Once that stock is issued, though, and someone's bought it, if it's sold again, the company doesn't get anything. So it's just reselling a kind of a second-hand stock. In other words, it doesn't give you any economic growth. So if I buy an Apple stock that already exists, it's not helping Apple. All it's doing is basically transferring the ownership of the stock from someone to me. So Apple can't benefit from my purchasing it at all. We also have to draw the distinction between exchanges in the sense that some exchanges are what they call OTC, over the counter. NASDAQ is one of those exchanges. So in the NASDAQ, basically there is no physical trading area. The shares are just bought and sold through a computer program. You get on the NASDAQ platform as a trader and you trade shares. You either buy or sell shares. And the brokerages are also involved in that as well. And on the other hand, the New York Stock Exchange has both over-the-counter types of trades like the NASDAQ does, but it also has open outcry. An open outcry is where traders actually do trades person to person through their representatives on the trading floor. So open outcry used to be the way in which all stocks were traded. Of course, now with the advent of computing technology, most of the trades are done through OTC, over the counter. So how do we price common stock? Well, there are a couple of different ways of doing it. The first way is the one that people kind of talk about most, and that is the kind of dividend discount model. So a dividend, by the way, not all stocks pay dividends, but a dividend is a share of the profits that are paid out. And most people who hold dividend paying stocks hold them because of that share out of the profits, and hopefully an increase in the stock price over time. But a lot of people hold shares without the share price increasing substantially at all. In fact, sometimes it can go down. But as long as you get a decent dividend, that offsets any fall or can offset any fall in the value of the stock. So dividends can be very important. So the current value of a share is really the future stream of profits. In other words, to put it another way, the future stream of dividends that you're going to get from holding that share. So we can write that in equation form as the present value, PVT, is equal to the dividends in the next period. If this firm was just existing for one period, plus the liquidation value in that next period. So most times what we do is calculate the dividends into the future because we don't know when the actual company is going to liquidate itself. So the market price of a share of stock is simply the discounted cash flows of the share of the share of stock provides. So in other words, the share of the profits into the future. And a lot of people do this as an infinite series. Of course, we don't know how long some of these companies will exist for, but we just have to assume that they're going to exist for a long time. So it's usually an infinite series. Now those dividends fluctuate, and so if a company's constantly been raising its dividend, that will tend to raise its price, sometimes quite substantially. Why? Because if there's an expectation of a rising dividend, then you've got an expectation of increased profits coming down the road, So you're going to basically add those in increasing amounts to that present value formula on the right hand side, and that will automatically increase the left hand side. It's also interesting, when a company stops paying dividends, you often see the price fall substantially. Why do companies stop paying dividends? Well, if they get into some financial trouble, and they need to conserve cash, or they have some opportunity to grow in some new market or something, then they might stop paying dividends. A lot of companies do not pay dividends at all because they want to plow all their extra profits that they get right now into growing the company. Obviously, that should be reflected in a rising stock price then. The other way is the dividend discount model. Oh, this is the multi-period version, sorry. So the price is equal to the present value of all the dividends going from now to infinity. In the Gordon growth model, the price of the share in time, period T, where G is the rate at which the dividend is expected to grow. So here we've got the example of a growth dividend. You would change that formula to the dividend over time and R minus G. So the growth of the dividend goes into the bottom of the equation. What effect does that have? Well, the growth of the dividend then reduces what you're discounting by, that R, and that obviously increases the present value. So rising dividend rate will tend to increase the stock price now. So here's the second way to calculate the price of a stock. It doesn't depend on the predicted dividends, is using what's called a price earnings ratio. So what is the price earnings ratio? It's essentially the price per share divided by the expected earnings per share. And that at the moment for the main stock index used in the US, which is the S&P 500, is around 22. In other words, the price per share is around 22 times the current expected earnings for a given year for that per share. So if you multiply the PE ratio by the earnings per share, then you're going to get the stock price. So that's another way of doing it. So just take the PE and multiply by the earnings per share. So you might want to say, give it a PE ratio of 22 because that's the average in the market, and then multiply by the earnings per share, and that tells you what the price should be. And that's how a lot of stock analysts determine whether stocks are undervalued or overvalued. Okay, when we look at the stock market in general, what determines, how the stock market moves? Well, they say that roughly 2/3 of the stock market return is dependent on the business cycle. So the business cycle here, the macroeconomic background, is very important for stock markets. In other words, if the stock market's gonna do well, then it helps to have an economy that's in an economic upswing or in an expansionary phase of the business cycle. Obviously, if the economy is in recession, then, or going into recession, then the stock market's likely to fall, reflecting more pessimism about economic prospects and therefore profits going forward, and therefore stock prices. So what we see is stock prices being pro-cyclical. That is, they move in the same direction as the economy. Usually they are good predictors of where the economy is moving as well. So oftentimes you'll see the stock market fall as long as there's, as soon as there's some kind of indication that the economy might be shrinking or moving towards shrinking. So the stock market tends to increase when the economy expands and decrease when the economy slows or slides into recession. And stock markets, because interest rates are pro-cyclical as well. That means as the cycle moves forward, interest rates tend to increase, and the market doesn't particularly like increasing interest rates because that means it's more expensive to borrow money. So often you see the stock market increasing through the business cycle, but each time the interest rates go up, the stock market will fall. So that result that the stock prices are affected inversely by interest rates is not wrong. It just tends to be on a slightly different cycle compared to the business cycle. And these days, financial markets are global. So what happens on the other side of the world can and does affect what happens in the equity markets in the US. And likewise, the US stock market is really a big driver of stock markets in other countries, as you'll see. Next, we want to talk about how we measure the overall stock market and its movements over time. So how do we do this? Usually we construct indexes, and these indexes are a selection of stocks whose price movements mimic the movement of the overall stock market, because their indexes represent the movement of the overall stock market. Now, these are usually big companies. So if we look at the Dow Jones Industrial Average, it consists of the 30 biggest industrial companies, and that goes into the Dow Jones Industrial Average. We have a wider measure of the market itself, which is S&P, Standard & Poor's 500. And then there's the Wilshire 5000. There's a zero missing there. Now, the Wilshire 5000 is really the largest and broadest measure of the stock market because it consists of 5,000 shares. There's a lot of shares traded in the US. And then the NASDAQ itself has two indexes that are used there, and that's the NASDAQ Composite and the NASDAQ 100. So as a country, we have a ton of indexes. Why? Because the US is the biggest stock market in the world by a long shot. So let's look at the S&P 500 over time. This is to April the 1st this year, so just to a few days ago. And you can see the red line represents the moving average of the S&P 500. And you can also see the periods in which the stock market falls. And those are the shaded lines. By the way, this is a log scale, just to make it clear. You can see the log scale on the left quite clearly. Down below, you can see the percent in which the stock market fell when we had those downturns. The major downturns that you see there tend to coincide as well with recessions. So we know we had a big recession between 2017 and into 2018. You can see that, 2007 to 2009, I mean, and you can see that right there with at the beginning of the series with the stock market moving down substantially, and it moved down by 56.8%. Now in the most recent downturn, which was in 2020, we saw a big downturn, and it was very, very, very rapid, very sharp, and you can see it's that shaded line there, pink. So the pink areas coincide with recessions, and it was a 33% fall in the S&P 500. Now the other shaded areas show periods when the stock market fell as well. So you can see that the stock market also falls cyclically, kind of thing. It has its own cycles, irrespective, so shorter cycles than the business cycle. just to show you some other stock market indexes as well. Here's the Dow Jones, the one I've just shown you. You can see NASDAQ, if anything, has been more rapidly going up since the downturn in 2020. It's absolutely gone nuts, I think. See that at the top right. We've got the S&P 500, which is the broader market index. That includes some shares that are in the NASDAQ, by the way, and some in the New York Stock Exchange. But and then there's the Russell 2000. Russell 2000 is a measure of small companies, and rather astonishingly, the Russell 2000, you can see the index has just exploded upwards since the downturn in 2020. In fact, small companies have been the best investment since March, since a year ago. They've just absolutely taken off. The Wilshire 5000 is the kind of biggest index. Another 3,000 companies added, and you can see it's also pretty similar to the Dow Jones Industrial Average there. So the Dow Jones Industrial Average, although it only has 30 shares, it's actually pretty representative of the entire market. And you can split this down, by the way, by sector. So there you can see the S&P 500, but it's not 500 shares in this case, it's the shares in the S&P 500 that relate to the transportation sector. So it'll be about, I don't know, 30 to 50 shares that go in there representing the companies that are listed on either New York Stock Exchange or NASDAQ that relate to transport. So airlines, railroads, trucking companies, etc., etc. Now I wanted to show you some of the stock market indices for other countries. The US really has done exceptionally well. When you look at, let me just flash back to the chart, you can see that since 2008, the bottom of the previous recession, the S&P 500 has moved from around 900 to 4,000. I mean, it's remarkable, 900 to 4,000. So it's gone up by about 4 times in the past, since the past trough, if you like, for the stock market. Now let's look at some other countries over that time. Australia, you can see it's gone from about 400 to 800. It's roughly doubled. So not as much as the US. China's gone from about 50 to around 100. So once again, it's doubled as well. Japan has gone from around 200 to a little shy of 400. So it's also doubled. And same for South Korea, and Taiwan has done even better. Taiwan in the nadir, the bottom of the cycle, was at around 150, and it's currently at around 700. So it's more than 4 times. So it's about the only stock market here that's performed better than the US. Let's show you some other stock markets that have really done worse than the US. You can see that 2008 in Hungary, for instance, their stock market was around 250. It's now at around, I don't know, 750, so it's 3 times. Egypt, bottom of the market was around, you can see around 400, and that's where it is right now, so no change. Czech Republic, you can see it's also fallen as well. It's gone from around 300 to, it's about the same now, 300. South Africa, though, has increased, because you can see the bottom there was around 200, and it's now at around 500. But notice that for these countries, not as much kind of increase in their stock markets as the US. This has been a trend, by the way, over the past couple of decades, and a lot of economists are thinking, well, the US has had a fantastic run, but at some point that might end, and perhaps some other country will have a sector or some remarkable companies that will drive their stock markets upwards. We're still waiting for that, though. Nevertheless, let me just add here, as an investor, I always make sure that I diversify my portfolio, not just in terms of shares, but also in terms of geographical location. So this is where your macroeconomics really helps. You can find countries that you think are a good bet going into the future and pick those and invest in their stock markets. Usually using an index is the safest way to do it, unless you know of particularly good companies in those countries. But that takes quite a lot of research. So most people would just buy a mutual fund that tracks the index for that country. So for example, students often ask me, what countries am I invested in? Well, I'm invested in India. I think is my biggest foreign holding. And I don't really have any Chinese stocks. I'm afraid I've tried to avoid China. I hold some South African, and I hold some Latin American, which have done terribly, some Japanese. I think Japanese is probably my second biggest holding, and European and Nordic. Nordic in particular, I think, is the best performing area in Europe and worth a look at. So my Nordic index has done pretty good. Okay, back to the US. How is the stock market regulated? Well, it's regulated by the Securities and Exchange Commission. And the Securities and Exchanges Commission was set up in 1933 and 1934 through the Securities Exchange Act. So the Securities Act of 1933 and Securities Exchange Act of 1934. And the Securities Exchange Act was the one that actually set up the SEC. And its mission is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. The SEC is responsible for ensuring that there's full and fair disclosure of information on securities to investors, and that this is not biased in any way. What do I mean by that? Well, there shouldn't be a collection of people outside of any company that are privy, so get information about what's going on in that company that other investors don't get. That's called that is illegal, and also you shouldn't be able to trade on information that you have from someone who works at that company as well. That's called insider trading. In other words, where you can be fed information from someone inside that company who knows what's going on before any other investor knows what's going on. Martha Stewart went to jail for that, by the way. The SEC is there to try and ensure that investors have complete and accurate information. So really what they're there to do is to minimize the asymmetric information problem, so that there's a full disclosure of what's going on in the company in a timely manner. And so all companies that are listed on stock exchanges in the US have to make quarterly reports. So they have to report on a quarterly basis about what's going on and produce accounts. Incidentally, in other countries, that isn't always the case. So in South Africa, for instance, South African companies only have to report every 6 months. And the same goes for the UK as well. So the US has really very much more intense kind of scrutiny from the SEC and a much more disclosure because of the SEC rules than in many other countries. Okay, so to end this chapter, we really talk about two kind of theoretical approaches to looking at stock markets. The first is the efficient market hypothesis. This goes back all the way to the mid-19th century, the mid-1800s. So the efficient market hypothesis argued that the stock markets are efficient and reflect all available information. So in other words, if the information's out there, then the stock will respond to that, and the stock will respond to that in a rational way. So the efficient markets hypothesis is really a hypothesis about rationality as well. So the efficient market hypothesis can be broken down into three levels of efficiency. The weak efficiency, which means that investors cannot earn an abnormally high profit by using historical price movements. In other words, if you look at where the stock has been before, you cannot earn an abnormally high profit by using those to try and forecast where the stock's going. Semi-strong efficient market hypothesis means that investors cannot benefit over and above the market return by trading on new information. So in other words, what the market knows, you should not be able to outdo the market based on the information that comes out. And then strong efficient market hypothesis. There's no set of information that allows investors to make an abnormal profit or a return greater than the market return. So in other words, you should not, over time, you can do better than the market in any one given year, but you shouldn't over time be able to outperform the market and do better than the market. That's the strong efficient market hypothesis. Now, most people acknowledge that the efficient market hypothesis does not work. However, it's like PPP, for instance, in international economics. However, is it a good kind of way of thinking about the markets? Yeah, it's a useful way of thinking about the markets. And sure, some of the ideas here, the fact that you shouldn't be able to earn an abnormally high return year after year after year above the market is, something that we shouldn't be able to observe. And so you can take some kind of ideas from EMH, or the efficient market hypothesis. What's more kind of in vogue these days is behavioral finance. And this is a recognition that markets are not fully efficient. So what it seeks to do is to bring cognitive psychology to bear and behavioral traits that humans have on markets, and financial markets in particular. So some of the topics now include things like overconfidence. One of the things that we have noticed is that people who hold stocks are always overconfident about the firms that they hold stocks in. So they always tend to have a greater degree of confidence than even the firm gives to investors. Also, investors tend to use confirmation bias. In other words, if they invest in a bunch of stocks on a certain thesis, if some of those stocks perform as they expect that they would do on that thesis, then they tend to think that they were right because of just those few stocks, and that confirms their thinking. Whereas if they look at some of the stocks that didn't perform well, they would realize that that doesn't, it doesn't always, it's not confirming what their hypothesis was. Framing matters as well, and of course, how over what period of time you look at stock market return and the stocks that you hold, for example. That's an important factor, and there are heuristics as well. Things like bandwagon effects. So if people think, oh gosh, electric vehicles are the best thing to get involved with now, that's the new emerging trend, we mustn't miss out on it, so let's jump on the bandwagon like everyone else is, even though the PE ratio on some of these stocks then goes to ludicrous levels. Well, that doesn't matter. So in other words, if you're convinced that everyone else is right, then you'll convince yourself to go along with that. A bandwagon effect, in other words. So is rationality a safe assumption to make when analysing stock market behaviour? Behavioural finance people would say no. There's lots of irrationality out there, and we cannot really model how stock markets will behave based solely on the rational models of market behavior. So here's some critical thinking questions. What are stocks? And what two components make up this market? And what two markets can you buy stock? Do you want to buy shares that have never been owned by someone else, in other words, an IPO? Or do you want to buy already outstanding shares? What exactly does this mean? What's an IPO? Well, we've gone through that. And is a high PE ratio a good thing or not? Basically, you can see the answers if you look at the PowerPoints here. So these are kind of discussions from what we've been talking about. And here we have a summary of the subject matter that we've just looked at. Thank you for listening.